So the other big area in personal finance that we want to cover is retirement. Retirement is something that people just don't understand very well. They know that it's coming at some point. They hope it's coming at some point. But preparing for retirement, something that could be 30 or 40 or maybe even 50 years away, seems like a daunting challenge. So what I want to talk to you today about is are the things So the other big area of personal finance that I want to talk about is retirement. Retirement can seem like a very daunting thing to most people. They understand that it's coming at some point. They just don't understand when. It could be 30, 40, 50 years or more from now. And they really don't have not even the slightest idea of how to approach retirement. I think with a few just basic ideas and understanding a few basic things, it can help you to begin to prepare for retirement in an effective and efficient way. So let's talk about some of the components of most people's retirement accounts. Probably the most common thing that people think about when they think about retirement or just personal finance in general is the stock market. And what we're looking at here is a picture of the value of the stock market since 1900. And you can see that if we start down here in 1900 and head up here to 2020, you can see that there's a significant increase in the value of the stock market. And what that refers to, or what that means, is that if you would have bought stock back here in 1900 and held on to it for the next 120 years, you would have made, and then you sell it, you would have made a lot of money. But there are some very clear ups and downs on the way. This one right here, for example, this is the big one. This is the Great Depression. This is the thing that everybody's scared might one day happen again, where we have this massive decline right here in the value of the stock market, almost to where it was in 1904. And this is 30 years later, and people are panicking, and lots of scary things are happening. But then you see a relatively nice increase, and then we have another decrease here right before World War II starts. But after World War II, or even in the middle of World War II, we start to see this really strong upward trajectory. We see some changes. We see a big dip right here in the mid 1970s. We see another big dip. This is the Great Recession, and it is nowhere close to what the Great Depression was. And then we see where we are today, which is right here. This is the drop in the value of the market because of COVID. And sort of, if we blow that picture up, that's what we see over on this side. We see that the market is heading upward, and it reaches way up here. It's getting up at near 29,000 in terms of value, and then it plummets. We see this enormous drop, and it looks like it's the end of the world, but really all we're looking at is this tiny little bit right here. That's what we're looking at in this blown up picture on the right. So it looks terrible, and it is bad, but then it bounces right back up. It's not quite as high as it was when the market started, but it is really, really close. And so that's the stock market, or the value of what we call the Dow Jones Industrial Average, which is just a part of the stock market. So when people think about personal finance, when they think about retirement, they oftentimes think about putting money into this crazy thing called the stock market, where we have these ups and downs that can sometimes give you whiplash. But the main idea with stocks is that you buy and hold. Buy and hold is the general idea that you buy stocks, preferably blue chip stocks, stocks of really significant companies, and then you hold on to them until you need to sell that stock for hopefully a higher price than what you bought it for. When people start playing the market on a daily basis or even a weekly basis or sometimes on an hourly basis, that's when they can kind of get into trouble. When they buy stocks at prices, they see a loss and they try to cut their losses. Really, the way you make money in the stock market is incredibly simple, no matter what any of movies would suggest to you about the intricacies of the market and trying to pick winners and losers. Really, the way you make money in the stock market is to buy a stock at a low price and then sell it at a high price. If you do that, you can make money in the market, just like all the experts do. And I don't want to say it's easy, because it's not easy. But if you don't get greedy, it's certainly possible to make money in the stock market. So let's talk a little bit about the specifics of the stock market, and then contrast that with something we call the bond market, and then talk about something that might take a lot of the uncertainty out of saving for retirement for you. So to most people, the exciting part of personal finance is the stock market. There have been lots of movies about the market, and fortunes can be made or lost in the market by making good choices or bad choices, as the case may be. There are television shows devoted to what's going on in the stock market, and they follow the market by basically second by second. But stock in and of itself isn't all that exciting. Stock is, or at least it used to be, a piece of paper that told you who owned a share of stock, and what that means is what number of outstanding shares were possessed by the holder, meaning that they owned a certain percentage of a company. Now, this stock certificate is kind of a generic one, but if you look here in the corner here where it says shares won, that means that this particular share of stock is representing one share. Now, there's millions, maybe billions of shares of Microsoft stock out there. So if you own one share of stock, that's not that big of a deal. But stock is a representation of what we call equity ownership. You have one share. Bill Gates has one share of stock. Now, Bill Gates has a lot more than one share, but up to a point, you are an equal owner in a company if you own stock. And the more shares you own, the more of that company you own. Now, the share of stock, being a stockholder, comes with specific rights and is and can be incredibly important and valuable. There are voting rights that go along with owning a share of stock. So you get to vote on things relevant to the company. Usually you don't get a vote on much, but you do get a vote on things like who runs the company on a day-to-day basis. When I owned Microsoft stock years ago, I had 10 shares. And because I was able to, I always voted against Bill Gates as being a member of the board of directors. Now, that didn't matter much because every share of stock that you own gives you one extra vote. So if I have 10 votes and Bill Gates has like 10 million votes, he's always going to be on the board of directors. But that's one of the rights you have as a stockholder. Is you get a vote on things like who is in charge of the company. You get a vote on other mundane things like who's going to audit the books. Every once in a while, you'll get a vote on a special dividend consideration. And I'll mention what dividends are here in just a second. But that's one of the things that you get to do when you're a shareholder, is you get to vote. As a shareholder, though, you also are privy to, or you are able to receive what are called dividends. Dividends are payouts of the profits of the company. So if Microsoft pays a dividend, and not all companies do, then you get a percentage of the profits for every share of stock that you own. The more shares of stock you own, the bigger your dividend check. And that comes in handy, as you'll see here in a few minutes. When we talk about stock, there are different types of stock. One of the types of stock is called a growth stock. Growth stocks work pretty simply. They work like anything in the market. If future profits look good, then demand is going to increase. In fact, we mentioned this when we talked about demand. Basically, this is the idea that people have an expectation of the future. And if the future looks good, then then the demand goes up for the product, and in this case, we're talking about a stock, and the result is a higher price. This is the foundation of growth stocks. People have a higher demand for stock if they think the price will be higher in the future. Of course, if they think the price will be lower in the future, demand goes the other direction and the price goes down. Growth stocks are those stocks that old adage that I mentioned earlier, buy low and sell high, that applies to growth stocks. You want to buy low, sell high, don't get greedy. Usually growth stocks do not have dividends. Any profits that are made by the company are turned right back into the company to help expand operations. Now, growth stocks, there are all kinds of different growth stocks. More recently, we've seen tech stocks be kind of the growth stocks. You can think about Amazon, for example. In 1997, when Amazon listed, it listed at $23.62. Today, the price of that stock is far, far higher, many thousands of dollars. So if you bought a lot of Amazon stock when it listed and you bought and held and you still hold on to it, you're making a significant profit on the purchase of that stock, and that's what we would call a growth stock. That's a really good example of a growth stock. But you do have to be careful. There are risks involved with buying stock. Sometimes the stock price goes down and you lose your shirt. If you would have owned Lehman Brothers stock, for example, whatever price you paid for it is higher than what it is valued at today, which is zero because Lehman Brothers, the company, does not exist. There's a lot of risk that goes along with stock, whether it's growth stock or the other type of stock we'll talk about here in a second. Growth stocks are the types of stocks where you make money if the value of the stock goes up. But that only works if you sell the stock. If the price goes up and you don't sell, and then the price comes back down, you make nothing. You must sell in order to make money with the growth stock. The other type of stock that's out there is called an income stock. Income stocks, with income stocks, we don't see huge price fluctuations. You will see some, but not a whole lot. Mainly with an income stock, you're going to make money on the dividends. So income stocks are stocks of companies that pay a lot of dividends or pay a consistent dividend. Utilities like energy companies, big name pharmaceutical companies, they pay dividends. Usually these are bigger companies that are, there is growth going on, but it's not rapid growth. So they're not turning their profits back into the company to expand their business. So that's a quick primer on the stock market. Obviously, there's more to it than just buy low, sell high, although that's a really good strategy and it's made people a lot of money over time. And there's more to it than just knowing what a growth stock is and an income stock. There's a lot of luck involved with the stock market. People often will just call the stock market legalized gambling. You can make a lot of money and you can lose a lot of money. And maybe you think you have a hot stock tip and it doesn't pan out, so you lose a lot. There are different stock markets. So you may have heard of the New York Stock Exchange or the NASDAQ. Most countries around the world, most major countries around the world have their own stock markets. There's stock markets in Britain and Germany and Japan and China and New Zealand even. So companies are traded on those stock markets, or the stocks of those companies are traded on the markets. And really, the stock market's just honestly, it's a big garage sale. Once the company sells stock, that's when they get paid. After that, it's people trading on the expectation of the price going up or down. And the companies who issue the stock don't get any more money. So when I buy and sell, say, Apple stock, Apple doesn't get anything from that trade. They only get money when the stock is initially offered. It's called an initial public offering. That's when the company gets paid. After that, maybe I make money if Apple stock price goes up and I sell, and maybe I don't. But it doesn't hurt Apple at all. The other, and probably the most important thing about the stock market is that there is a lot of risk involved. The stock market entails risk because there is no guarantee you will get your money back. If you buy stock and the company goes belly up, too bad for you. If you buy stock and the company does extraordinarily well and you sell, good for you. But people have lost a lot of money in the stock market, just like people have made a lot of money in the stock market. And so if you're willing to take the risks, then maybe the market is for you. And over time, as a whole, the market goes up. At least that's what we saw in that graph. Sometimes it goes down, but eventually it should go up over time. Now, if you're not so interested in risk, maybe bonds are what you should consider. Bonds are just pieces of paper also, but they're a little bit different than stocks. Actually, they're a lot different than stocks. Bonds are what we call IOUs. It is basically a loan that you are making to whoever issues the bond. And bonds are issued by governments as well as companies. So if you buy a bond, really what you're doing is giving the company or the country who issue the bond money. And there's a promise that that country or company will repay you. All bonds have specific parts, things that are just a feature of the bond. So we have a savings bond over here, and in this bond we see the specific parts. This is basically someone has given this money, it looks like Edgar H. Burton, has given money to the federal government. And one of the things that the bond tells you is who is going to repay the bond. In this case, it is the United States of America. They're going to repay the bond. That's one part. You've got to know who owes somebody money. Now, the second part of the bond is the maturity date. This tells us when the money will be repaid. Of course, that would be kind of interesting to somebody who owns a bond. When am I getting my money back? And here we see the date is September 6th. This is an old bond, 2002. That's the maturity date. So here this is over here. And the third thing that all bonds have is what's called the par or the face value. That's this $5,000 here. The par value is how much gets repaid when a bond matures. In other words, when it is time to repay someone, how much do you get repaid? Those are the feature of all bonds. Now, this bond says it's to Edgar H. Burton, but that doesn't mean that it's going to be repaid to Edgar H. Burton. Edgar H. Burton may get the money back and he may not, because bonds can be traded, just like stocks. We call that the secondary market, and whoever owns the bond or whoever holds the bond on maturity date, they're the person who gets the money. So how do you make money on bonds? Well, you can buy it at a low price and sell it at a high price. Or you could sit back and collect the interest that is owed to the person who holds the bond. So I mentioned that idea of lending somebody money. Well, you're not going to lend somebody money without expecting something in return. In the world of bonds, that's called an interest rate. So you get paid by the borrower of your money because you have given them that money and now you can't do anything with it. So they have to pay you an interest rate to get your money. And so that's one way to earn an income off of bonds. You get paid interest rates. Now the interest rate that you get paid on a bond is kind of an interesting thing. The interest rate itself can fluctuate. It's not fixed. If you notice, it wasn't stamped on the front of that bond that we saw. Interest rates depend upon the relationship between the par value, the face value, that $5,000 we saw on the bond, and how much is actually paid for the bond. So let's take a look at that and try to understand something about different kinds of bonds. So to figure out the interest rate on a bond, what you do is you take the par value, you subtract whatever price you paid for the bond, and you divide that by the price paid. When you buy a bond, most people don't buy a bond for whatever the par value is. So if the U.S. government wants to borrow money from you, and they're willing to give you a $5,000 bond, you're probably not going to pay $5,000 for it. That would be silly. You would give the U.S. government $5,000 today to be repaid $5,000 in the future. That's not how bonds work. Let's see how a bond would work. Let's just put some numbers in here to see if we can figure out the interest rate. So we know that the par value of the bond we've been looking at is $5,000. So let's just say that you give the government $4,000 and they give you a $5,000 bond. That's a promise to repay in the future. So if we drop our numbers into our equation here, we end up with 1,000 over 4,000, which is a really nice interest rate of 25%. So that's how we figure out the interest rate that's paid on a bond. We need to know the price that's paid and the par value. But what happens if you want to sell that bond and you sell the bond to somebody else for, say, $4,500? Well, the bond still has a par value of $5,000. If somebody buys your bond for $4,500, they now start getting the interest payments that you would have otherwise received. But the interest rate that they get is not quite as good. It is now 500 over 4,500, which gives us an interest rate of 11%. Still pretty good, but not as good as 25. So what we can say is that when we look at bonds, as the price of a bond goes up, so this is the price that's paid, we're talking about the difference between 4,000 to 4,500. As the price of the bond goes up, the interest rate goes down. And that's what we see here. We go from 25 down to 11%. So making money on bonds can happen when you sell the bond. It also happens when you earn an interest rate. And as that price that's paid for bonds when they are traded, if that changes, that's going to change the interest rate. At higher prices, we have lower interest rates, and at lower prices, we have higher interest rates. It seems like that's a little bit counterintuitive, but that's what the math shows us. There's one other thing about bonds that's really important, and that is, how do we actually determine the interest rate? You know, I mentioned that stocks are very risky. Bonds aren't nearly as risky because they are contracts. They're promises to repay somebody. So the likelihood of you getting repaid is actually rather high compared to a stock where if the company goes bankrupt, you're out of luck. If a company goes bankrupt, bondholders will get paid. They'll get paid something, maybe not the full amount, but they're high on the priority list. So bondholders have a lot less risk. Nevertheless, risk plays a role in determining what the interest rate will be when it comes to paying people who lend a company or a country money. So let's wrap up our discussion on bonds by looking at what determines the risk that in turn determines the interest rate. The risk factors for bonds include credit worthiness. We talked about your credit worthiness when we discussed credit reports. Well, the same thing applies for companies. There are credit rating agencies that give companies and countries a letter grade for credit worthiness. Ratings for credit worthiness are kind of like letter grades that you would get in a class. If you have an A, that's good. If you have a C, that's not so good. But the credit rating schedule is a little bit different. We have A, AA, and AAA rated bonds. Those are really good. And even double B rated bonds are considered investment quality. But once you drop below double B bonds, things get a little bit dicey. You have B ratings and C ratings. And if you go down the list far enough, you end up with what's called a junk bond status. Junk bonds are really, really high risk. These are companies that are on the verge of going out of business. AAA rated bonds are bonds of companies or countries that have always paid their interest rates. They are on solid financial footing. You almost don't have to worry about getting repaid. You're going to get your money back. Now, this affects the interest rate just like it affects the interest rate you would pay on a credit card or a mortgage. The less risk that is seen for lending somebody money, the lower the interest rate that they have to pay. So if you are a company or a country that is a really good risk, you have a really high credit score, credit rating or a credit score really, then the interest rate that you pay for borrowing money will be much lower. If you have a junk bond status, you're going to have to pay a lot of money to entice people. You're going to have to pay a lot of interest to entice people to lend you money because right now you're in trouble of staying in business. So the creditworthiness is the number one thing that affects the interest rate that a company pays. But there are two other things. One of those other things is the time until the repayment is made. Bonds can be almost any length of time. And the less time it takes until the bondholder gets repaid, the less risk there is, because there are fewer things that could happen. So if you have a bond that's paying off in 6 months, there's a lot less risk involved with that. And if you were to try to sell that bond, the buyer would get the interest rate would not be incredibly high because there's not a lot of time for things to go wrong. On the other hand, if you're not getting repaid for 30 years, there's a lot that could go wrong there. Even the best run company could go out of business. So the interest rate is going to be higher, or at least it tends to be higher on longer term bonds because there's more risk. Finally, there's something we call tax risk. Tax risk exists in the bond world because any interest that you earn or any money that you receive from selling a bond is taxable income. So if taxes change on that taxable income, then your return for holding the bond will go down. So anytime you have to pay tax on the income that you receive from a bond, there's a tax risk. There's a risk that the law might get changed and you'll have to pay more in taxes for that interest income or for that bond income. But you can avoid this tax risk by buying a special type of bond called a municipal bond. Municipal bonds are issued usually by localities for big projects, road projects, bridge projects, sometimes hospital projects, things like that, big infrastructure projects. And the municipality or the local government that issues a municipal bond is a super great credit risk. They're the best. They're AAA rated bonds. And as an incentive to be a locality that is really excellent in repaying their bonds, paying their bondholders, there is this provision that allows them to charge a very low interest rate, but the interest that is earned is tax-free. Because it's tax-free, there's no tax risk. You're dealing with a government that has a super high credit rating, and so the interest rate is going to be really low because in essence you're eliminating a couple kinds of risk. Municipal bonds are really good bonds for people who have a lot of money and don't want to pay taxes, really. It's totally legal. We're not talking about anything nefarious here. But if you have a lot of money and you buy tax-free municipal bonds, then you have the potential to earn income on which you do not have to pay taxes. Now, the opportunity cost for that, of course, is that you're not going to earn a lot in interest. So maybe that money could have been better used elsewhere, but at least you're not paying taxes. The final thing that I want to talk about in terms of retirement is the importance of diversification. Whenever you are looking to the future, you don't want to put all your eggs in one basket. And there are tools that are available to people who are saving through financial planners and just the general market that are called mutual funds. Mutual funds are ways of diversifying risk. Basically, a mutual fund is buying a little bit of a whole bunch of different stocks. One way to think about it is to think about a window pane where you have one of those old-fashioned window panes where there was a separate piece of glass in each one of these tiny little frames that made up a larger frame. You can think about a mutual fund in that way. Now, the reason these old-time windows had these smaller panes of glass was that it was expensive to replace a pane of glass. And so if one of these breaks, you don't have to replace the whole window. That would have cost a fortune back in the day. You only have to replace the one small pane of glass that's broken. A mutual fund works the same way. Let's say you have a bunch of different stocks. We'll put Home Depot here. We'll put Microsoft here. We'll give you some Apple. And let's say Tesla. And I don't know, just throw a couple of, there's IBM, McDonald's, Nike. Oh, let's say Nordstrom, the department store. Let's give you a bank. We'll give you a Citibank. And this guy right here, Washington Mutual. It's another bank. So this is a mutual fund, and you have fractions of shares of stock for every share of the mutual fund. And the value to this is now you are very diversified. You don't have all of your eggs in the Apple basket or the Nordstrom basket. Now, what could happen, of course, is that one of these companies might tank. And Washington Mutual was one of those companies back during the Great Recession, during the financial crisis of the late 2000s. That company went out of business. If you had all of your stock in the Washington Mutual basket, you were in big trouble. But if you had a mutual fund and Washington Mutual Bank was part of your mutual fund, well, you broke a window pane of glass. You didn't break the whole window. Mutual funds allow you to diversify. And if you're going to save for retirement, and I hope you will, diversification is incredibly important. So saving for retirement includes a lot of different things. It includes stocks and bonds. It includes mutual funds. But we can also pay attention to things like IRAs and Roth IRAs, 401ks and 403bs. There are lots of different vehicles for retirement. Let me just give you a little bit of detail on the IRA option. An IRA is what's called an individual retirement account. This is where you put money into an account with your name on it, and when you retire, that money is all just for you. This is not like Social Security, where everybody contributes and then money is dispersed amongst people. An IRA is a personal account. One of the advantages to having an IRA is if you put money in the IRA, you can use that as a tax deduction. So you put the money in the IRA, and whatever you contribute is a write-off. You can reduce the amount of tax burden that you have. The problem, though, the catch, is that the money in your IRA account accumulates over time. It'll compound and all of that good stuff that we've already talked about. And then when you start to take withdrawals out of the IRA, those withdrawals can be taxed. That's a downside for that IRA. A Roth IRA is very different and can be incredibly beneficial to you over time, because what happens with a Roth IRA is that you pay your taxes up front, you put your money into your account, you don't get any tax write-off. But then any money in the Roth IRA accumulates tax-free. No matter how much money you get out of that IRA account, if it's a Roth IRA, that money is basically tax-free. So when you start to withdraw your money, once you've retired, you don't have to pay any tax on it. And that can be enormously beneficial once you get to your retirement years. You can have a huge pile of tax-free money waiting for you when you retire. Now, 401k plans and 403b plans, those are employer contributions to your retirement plan. So you put some money in typically, and the company you work for matches those contributions. Sometimes they match more, sometimes they match a little bit less. But it's a special plan that allows you to save for your retirement. And the company that you work for helps you save for retirement. But once you retire, then the company is, hey, thanks for all the service you've given us. You don't get anything else from us. We've been contributing to your retirement plan over time. This is not a pension type of plan. Where a pension would be when your company essentially pays you once you retire, and they pay you for probably as long as you live. But pension plans aren't as prevalent as they used to be. Those things are really expensive, and companies don't want to pay pensions. So it's up to you to save for your retirement. The last thing I want to say is just to re-emphasize the importance of starting early. We talked about compounding and how vital that is. Here's a picture of compounding. So let's say you start saving $100 a month, and we'll assume a 5% interest rate. After 1 year, you would have saved $1,200, but you have $1,233. You may not think that's very much, but that's interest that will now compound along with the money that you continue to put into your account. Again, $100 a year for 5 years would be $6,000. But because of compounding interest, you now have $6,828.94. If you continue to save $100 a month, for 10 years, you will have saved $12,000. But with compounding interest, you now have $15,592.93. And now things are about to take off. 20 years into saving $100 a month, you've saved $24,000. But you have $41,000 thanks to the compounding interest. And in year 30, you have over $83,000. And then at year 40, when you're getting close to retirement, you have $153,000. And you've only saved $48,100 a month for 40 years. That's the miracle of compounding interest. But it only works to your advantage if you start early. Even if it's a small amount, once you get a job, start saving. If your company has a 401k plan or some matching contribution to your retirement, take advantage of it. Get them to put as much money as possible into an account for you. If you can, if one of those options is a Roth IRA, take the Roth. Let that money accumulate tax-free so you don't have to pay taxes on it when you take it out of your accounts. Well, that's just some basic common sense thinking for retirement. Saving for retirement is something that you're going to have to do. Social Security is not going to allow you to maintain the standard of living that you become accustomed to. And if you start late in life, you're not going to take advantage of that compounding. So save what you can, as much as you can, early on. And with compounding interest, you're going to be able to retire comfortably and not have to worry about financial issues in your later years.